You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate investment expert, Buck Joffrey. Buck is a physician, entrepreneur, asset manager, and fellow podcaster who has enjoyed a great deal of success through his multiple businesses and investments. So much so, in order to help his high-paid professional colleagues, he even started a financial education website called wealthformula.com, which also serves as home base for his Wealth Formula podcast. He currently has a real estate portfolio consisting of nearly 1,000 apartment doors, multiple resort properties, medical office space, self-storage, and the list really goes on and on. So we're going to talk to him about that today. But really what I'd like to do is dive in and uncover the intimate details of Buck's business, really his real estate business, but also some of the other things he's involved in so that we can learn the strategies that he's used to build a multi-million-dollar real estate portfolio. But before we get on to the show with Buck, I want to run through a quick items with you guys, just a few items and updates. First of all, you guys know that I'm in mobile home parks. We're in the mobile home park space. That's what we specialize in. I've been doing it for going on 6 years. And I'm just telling you this because we're in acquisition mode and we're looking for additional properties. So I know that we kind of cross the gamut of many different types of assets on this show. And so depending on what you're investing in out there, what you're looking for, what you're out there in the hunt for, if you run across any opportunities in the mobile home park space that whether it's something that you just don't have an interest in, but you think might be a good opportunity, or maybe it's a deal that you can't take down on your own, you might be looking for a capital partner or an operational partner, or maybe even both. We're looking for opportunities, bottom line, and we'd love to talk with you about anything that you might have that could fit our criteria. So just very simply, anything that's 60 plus spaces in size and is in a metropolitan area of 100,000 plus in population, that's a very small metro, we would consider it and would like to learn more about it. We do have other criteria, but don't want to go into too much detail here on the show here. But if you have anything of interest or that might be of interest, just reach out to me directly. My email is kevin@kevinbupp.com. That's my personal email. Just shoot me a quick email. Let me know what you have and what you'd like to chat about, and we'll jump on the phone together. We can handle deals upwards of $25 and $30 million. We can handle portfolio purchases, and we're willing to pay big finder's fees if you find something or even partner with you on it. So again, many different opportunities available. We're very flexible. Next up, guys, I got some good news. I wanted to let you know and give you an update about the second fund we've been working on. If you've been listening in for the past couple of months, you know that we closed out our very first mobile home park fund and are rolling out the second one and expect to have it out in the very near future, probably in the coming a month or two. So if you missed out on that first fund and have an interest in partnering with us in the second mobile home park fund, be sure to go to our website, sunrisecapitalinvestors.com, and create a free account inside our investment portal. This will basically place you on the first to know basis for when this second fund rolls out, and we're really expecting it to fill up pretty quickly based on the demand for that first one. In addition, there's a link where you can schedule a time to jump on the phone with our team to answer any questions that you might have about this future investment opportunity. Now, I'll tell you that we already have 3 parks in contract to put into the second fund and another 4 in the pipeline that we're working towards getting into contract. And we've been really ramping up our acquisition. So expect to build that pipeline out over the coming months. Lastly, guys, if you happen to be in the Tampa Bay area, that's where I'm based out of, I'd love to meet with you. So if you find yourself visiting, you got some extra time, let me know, and let's try to coordinate a time to get together. I love talking shop, love talking real estate, and just meeting others that share the same passions as I do. So you can shoot me an email, again, kevin@kevinbupp.com, and just let me know when you're coming into town. Let's see if we can try to coordinate our schedules. So without further ado, guys, I'd like to welcome our guest for this week's show, Buck Joffrey. Buck, how you doing today?
Doing good. Thanks for having me.
Yeah, looking forward to diving into your business, Buck. But before we get too far along, what I'd like to do, I gave you a very, very brief introduction. Just based on what you own in your real estate portfolio, not even mentioning your other businesses, your background's pretty extensive. So what I'd love you to do, take a couple minutes and give our listeners a little bit more of a background about yourself and or I guess lead us up to where we are today. I mean, just a very quick synopsis, if you would. There's a lot there, so we've only got limited time, but try to give us a 10,000-foot view of who you are and what your background looks like.
Okay, yeah. So let's see. So I started out like most A students, right? I did all the right things, got A's, went to college, went to medical school, and actually started out as a brain surgeon. I did that for a couple years, and I didn't like the hours. Can you imagine that? Getting called in the middle of the night.
I'm sure that would not be fun.
I switched residencies, ultimately ended up as a cosmetic surgeon. Okay, but that's a lot of training. By the time I was done with all this stuff, I'm 34 years old. I'm 44 now, by the way. And when I finished my residency, literally a week later, I get married on the honeymoon. On the way back from my honeymoon from Puerto Vallarta, I find a book in a dingy Mexican bookstore called The Cash Flow Quadrant, which was Robert Kiyosaki's book, and read that book effectively just on the flight and came off that flight completely transformed. Up to this point, I'd been a complete academic guy. You know, you don't go through all this stuff and publish all these papers and write book chapters and become go to a neurosurgery residency, head and neck, plastic surgery, and all this without, being fairly, to the grind when it comes to academics. But it all changed. And all of a sudden I wanted to be an entrepreneur. All of a sudden this whole world opened up to me that I didn't even realize was there. And isn't that the classic Purple Book story?
That is.
It's classic.
It sure is.
And I told Robert Kiyosaki this story last April, Kevin, and he was like, I thought he would be like, way to go. And he's like, well, I'm sorry we lost a doctor. And I said, Robert, come on. I've been waiting to tell you this story for 8 years. Anyway, so bottom line is I pivoted at that point. I had a medical background. So in plastics, I started a plastic surgery business. And I call it a business because I was the owner-operator to begin with and then sort of phased myself out pretty quickly over the course of a couple of years and started hiring other guys. I ran it like a business from day one, advertised like crazy. I still own that business, haven't practiced in that business for about 3 years now. But it is a business, man. I mean, it's $1 million advertising budget alone annually. I mean, it's a hardcore business. It's in Chicago. I don't live in Chicago anymore. I live in Santa Barbara, California. So I did that a couple times in other businesses in Chicago that were medical related. Some of these things were not in my exact specialty, but ultimately it was like running any business. It's just I had a background. So entrepreneurship first. Here's the thing. When I realized the way people invest once they start making money, one of the things that I realized from reading Kiyosaki's book, and also my dad I grew up with a real estate investor dad, was this, is that most people, even these super fancy hotshot entrepreneurs who find out, really creative ways to make money, when it comes to investing their money, they turn into their grandma, right? I mean, they just hand it over to a wealth advisor and stocks, bonds, and mutual funds. I'm like, there's no way this is going to happen. Now, I finished my training in 2008, so it was a perfect time to say, there's no way I'm going to do that because I just saw what everybody was getting killed. And I look at my dad, he'd made mistakes in the past, but he was ready for 2008, and he bought up a lot of stuff, man. And so that got me down this road of saying, hey, there's another way to invest this money. If I'm going to make a lot of money, I got to figure out how to grow it faster. So I approached investing the same way I approached entrepreneurship, right? Which is that don't just take what's out there and be an employee to the wealth advisor. Go figure out how to create your own wealth through investing. And real estate was a natural fit for that. That's where it started. But in reality, you called me a real estate investor. I am actually asset class agnostic. I love cash flow, but at the end of the day, some people, when they get to a certain point, they don't necessarily need just cash flow anymore. So it might be worth looking at things that create more equity and long-term opportunities with upside. So the bottom line is I became what I call myself right now is ultimately a financial educator and professional investor. I don't practice anymore. So that 34 years of training,
That's all right. It was a good foundation, right?
It was a good foundation. But hey, you know what? It was actually a great foundation because now, too, my audience is, I talk to on my podcast, on Wealth Formula Podcast, I talk to people who have sort of my background, right? People who are, high-paid professionals, people who are lawyers, doctors, software engineers, people who are making six figures, and they have maybe lost a little bit of faith in Wall Street and want to figure out how to educate themselves and empower themselves. So this is ultimately, it's all for that purpose.
Well, fantastic. That's a great story. And I really want to focus, since we're a real estate show, I'd love to talk to you about many other things. Again, we could spend hours and hours on this show covering all the different bases, but I want to focus on the real estate side if we could. Now, you mentioned you went ahead and started that plastics company along with a few other medical related companies. But I want to know, at what point in time did you dive into the real estate side, and what did that first investment look like?
Yeah. Yeah. So, after I read Kiyosaki's book, I read Ken McElroy's book on ABCs of investing in real estate, and then the advanced book, which is funny because, again, all these people who I learned from, I know them, and it's really cool now. And I'm just finishing up on a course, and I was telling Ken McElroy this story where basically I had read his book, and he made it sound so darn easy, right? I mean, he made it sound so easy. It's like, okay, you do this, cap rate, that, blah, 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 net operating income. Shoot. So I'm super cocky thinking, I mean, listen, this isn't brain surgery, right? And I could say that. And so I literally went out there, and what did I do? I went on to, what's that site that everybody goes on where the
LoopNet.
LoopNet, yeah, where deals go to die, right?
Yeah, that's it, the trash can.
Yeah.
Yep.
And I went on LoopNet, and I was like, why? Well, I'll just search for cap rates. I just look for
oh gosh,
cap rate. So I went in there, and I just, I did the numbers, and anyway, long story short, I bought this building. It was a 14-unit apartment building. All the numbers worked out, but the real, the components that maybe I didn't understand, the human components, property management, the area, it was a D-class property, bad idea.
Oh.
All these things that I've since learned, I took a big loss in that building. That was the first and last real estate project that I took a loss on, and I lost like $300,000. And I will say that I like to think of that, we have a common friend, Rod Cleef, who calls it, the big, his big $1 million whatever education.
Big $1 million seminar.
Yeah, right. So this is this was my $300,000 course in real estate. That's what it was. So,
well, I don't want to put too much emphasis on that, but that is, we talk about foundations, right? That's kind of the foundation of the real estate side of your career, of your investing career. And so I want to talk about it a little bit, although I know you've done many other things since then. This is the only deal you've ever lost money on, but I want to talk about it because I don't feel like we're growing unless we're making failures.
Sure.
And I can say that I probably fail one way or another every day, which is a good thing. I see it as a good thing. It's always about the takeaway. What kind of lessons can you learn from that experience? And so I want to talk about this first deal, this one where you shopped on cap rate, which is the wrong filter to use in LoopNet.
Yeah, absolutely.
Because you end up with a D-grade property, probably in a war zone, one that literally got shopped around to hundreds or thousands of people, and it was that bad, and either that bad of an area, that overpriced, or combination of the two, to where no one wanted it. And so went to LoopNet to put it out to the mass marketplace to see who would be the sucker, I guess. Though not calling you a sucker.
Oh, I was a sucker. I was a sucker.
Yeah. Yeah. So talk to us about a little bit, I guess the area, what would you have done differently going back into it? I know you probably wouldn't have bought it, but let's assume that you knew a little bit more regarding the market research side of things, actually evaluating cap rates maybe properly. I don't know if it was proper or not. I don't know if you actually had all the accurate expenses when you're doing your analysis and your underwriting, but just tell me a little bit more about the deal, I guess, if you would.
Yeah. So let me, at a high level, I think it started, the first problem was that I had, the broker I used was not a guy who really understood commercial real estate or multifamily real estate. I used the same broker I just used to buy a $2 million house for myself, right? So luxury guy, luxury guy on the North Shore of Chicago. And I'm like, hey, let's go buy some, let's buy some income real estate. So he didn't know what he was doing either. And he was just basically going to be in the line of fire for a commission, right? And he wasn't a bad guy. I don't think but he didn't know what he was doing. And I do think it's important to have, people, brokers, whatever other advisors you can get who can really, really help you understand an area, help you understand, the type of property you're getting. You can certainly do that research on your own, and you should, but it's also helpful to have someone who can give you proper guidance. And I didn't have that. So that was the first thing. The second thing is I relied, as an analytical guy, I relied on the math only, right? And the math is what it's easy to do. I mean, read Ken's book, right? I mean, it's easy. And the math looked great. And some of the things that are important that we know are really important, like, for example, vetting the property management company, vetting the area, I didn't do as well. So the way I vetted the area is I drove down there during the day, and looked around. It didn't look too bad. And I turned to my broker and I said, is this area bad? And he said, looks okay.
Oh, gosh.
Right? Listen, and it sounds so stupid, right? But it's just, you look back and you're like, okay, well, I learned my lesson there. And then when it came to the property management company, I actually did not think of, the property management company before I bought the property, which is one of the biggest mistakes I think that you can make. Especially for people who are investing outside of their, their comfort areas, if it's not totally in your backyard, whatever. But I didn't know this area very well, and I didn't have a property management company in mind to start. So, when it came time and in closing was coming, I was like, okay, well, I need a property management company. And then I started looking, and here was the biggest mistake I made. So I just said, well, the property management company that is managing it right now is doing pretty good job, right? Let's just keep them on. Right? Okay.
Sure. Yeah, that makes sense.
Makes
right?
sense,
I mean, logical.
right? Again, yeah. So what happened was after the closing, pretty quickly, all that cash flow that seemed to be coming in, it didn't come in anymore. And what happened was that this is Chicago, like everything's corrupt, right? And as it turned out, the property management company was actually owned by the previous owner. Okay.
Oh, gosh.
Right. And I didn't know that. I actually didn't know that. And it was not disclosed. I know to disclose that, right? The guy who was going to manage it, he didn't tell me it was owned by the... Right.
Oh, my gosh. Yeah.
Anyway, so what happened was, it's really hard to do the forensics on this deal. But at the end of the day, he owned multiple properties in that area. He was selling this one. He cooked the books. He basically was, I think because he had multiple properties in the area, he was sort of shunting rents and basically cooking the books.
Yeah, no, I get it. I get it. Okay. Well,
so Kevin, here's the thing: this property was not an incredibly expensive property. I mean, it was like maybe $600,000 or whatever. And so at that point, when I figured that out, the first thing that went into my mind is, that sucks. What am I going to do? I'm going to sue this guy. All right. So there's another lesson. Now this is sort of related to real estate, sort of not, right? But my equity in this thing was maybe $125,000, $130,000. Mm-hmm. And the legal fees to go after this guy and try to do this would have been huge, right?
Yep.
So basically, there's another lesson is like, you know what? Don't expect like the law to protect you, because at the end of the day, it's going to cost money. So if you make a mistake, you're screwed, mm-hmm. right? And you're going to pay for it. And that's what happened. So.
Yeah. I mean, the cost benefit analysis on that of going after that guy, I mean, it's just not worth it. It's not worth the energy, the brain damage, or the costs associated with it, or what you might potentially get as the reward on the back end if it actually even happened.
Yep.
No, that makes sense. Well, I wanted to hit on a point you mentioned in the beginning. One of the first mistakes was using the same broker that sold you your $2 million home, which is a residential broker. And that could work it could work against you or it could work in your favor. We've had it both. More commonly, it works against you because they have no idea what they're doing. Sometimes that is helpful because they'll get a listing on a property that they shouldn't have, and their evaluation will essentially undervalue the property, because they don't know what they're doing. They really don't understand income real estate. And we have bought multiple properties that way to where they were just listed wrong. They were listed wrong because the broker didn't underwrite it properly and he undervalued it, and the owner didn't know any better.
Well,
and so they sold it, for hundreds of thousands less.
For clarification, my broker was not listing it, right? So my broker was just
I understand.
Buyer's broker. So
no, I understand. Yeah, absolutely. But sometimes that can work in your not your situation exactly, but it can work in your favor to have a broker that doesn't necessarily know what they're doing. If they are the listing broker, is the best way to put it. Okay, well, good deal. So let's move on from that one. We got the mistake. We got the lesson learned. I know that you really put yourself more as an opportunistic investor. I mean, you kind of, again, you run the gamut of the different asset classes. You'd mentioned that you own resort properties, lots of multifamily doors. You syndicate multifamily. You got self-storage properties. You got medical office. What would you say, of all of them? Maybe you don't. Maybe you're just strictly a numbers guy. There's absolutely no emotions whatsoever. Is there a favorite asset class between the ones that you own, or no?
No. It's a numbers thing for me. For me, investing it really is not emotional at all.
Good. That's a good thing. So tell me about the fundamentals you look for. When looking at an opportunity, let's talk about an opportunity, not asset specific. Markets. Is there particular markets that you like investing in that you've really honed in on over the years, or are you kind of all over the map?
I'm all over the map. I have multifamily, a fair amount of multifamily in Texas. But it's in the last
Dallas-Fort Worth.
Yeah, Dallas-Fort Worth and surrounding areas. But the thing that I try to do, here's what I really try to do as an investor now. Okay. What I'm most interested in, Kevin, and I think you'll appreciate this, is I'm most interested in partnering or there's two ways I'll acquire properties. Okay. One is if they're handed to me on a silver platter. Mm-hmm. And this happens now more often than you think, because as you know, you start buying stuff, people will give you stuff, right? So let's talk about real quickly in terms of the next two properties I bought. I had become good friends with a guy with who was a mortgage broker who had a little fund, a notes fund for commercial real estate. And he and I became good friends, and he actually brought two properties to me at once because another guy in his fund said he needed to get out of these properties, not because they were distressed, but because he had another opportunity and he needed liquidity. And so he knew I could bring the capital to really quickly and close the deal. And he already underwrote the deal for me. I, of course, did my Ken McElroy math. And this time I also, I found a property manager, got the best I could in Chicago, and boom, this one from day one, with leverage was making 20% return, right? These two, and now both of them actually have increased in equity by $1 million in it's about 7 years.
Wow.
Of course, some of it's dumb luck, right? Listen, we're in a massive, cap rate compression world, but the point I'm trying to bring is that the first thing I do is I need to know that the deal is real, because the math can be done. It's easy. The math is real. The question is, where's the math coming from? That's the biggest question. And for me, if I'm going to acquire a property on my own, I need to have a lot of information on that property, what's going on, and I need to have insider information. I only will invest with insider information. And I'm not talking about the illegal stuff, obviously. But
I understand.
in real estate, we have a unique opportunity to get insider information, whether that's from people in the city council, whether boots on the ground, people who are heavily involved in a given market, et cetera. Now, the other way that I acquire property is actually by partnering through very experienced owner-operators. So in these cases where I'm syndicating, for example, we self-storage opportunity in Naples. This is a group I have been talking to for 2 years and talked to a lot of the investor groups, mostly family offices that had worked with them and had gotten a tip from a very good friend of mine. They have a 30-year track record in just self-storage. They're highly specialized, right? Mm-hmm. They like working with guys like me who are interested in investing and who can potentially bring capital with my investor group.
Yep.
And so that's sort of my modus operandi now. That's mostly what I do. Is I spend my time, really vetting deals, vetting teams, and then the numbers after that. Right? Then the numbers come because I need to figure out who I can trust the numbers from first, right? So I call this tribal investing, okay? I call it tribal investing because at the end of the day, the people I'm creating these relationships with, before I'll do do a deal with them, they have to feel like if it doesn't go well, they're going to feel bad. That's how much I need to know these people, and they need to know me, and that's when a deal is going to happen, and I won't do it otherwise.
Yeah, fantastic. I want to talk a little bit about a structure that's common to you today. You mentioned that you were looking at the self-storage opportunity that's operated for a number of years, and obviously you're acting as an LP in the deal, or maybe I don't know if you're the LP or GP side, but either way, you'd mentioned that you also have the ability to bring capital to the table, which is through your immediate network. Is that a format to where you might put like a special purpose vehicle together and then have a fund that invests in that syndication? Is that typically what you would do?
No, so the only way I'll do this, so I'm very specific about this. I don't. The only way I'll do something like this is when the GP, when my equity and what I make on the deal, whatever profit I'm making is coming from the GP side. So
got it.
I don't. I'd never come in and sub-syndicate because, as a general rule, I don't like that. As an investor, I don't like that. I'd rather, if I can invest in a deal myself, I want to know about that. And I don't want to feel like somebody's just creating more fees and
sure,
all that for me. And I'm in a position right now, quite honestly, where I can be picky and choosy. I'm not out there. I don't need to do deals, right? So, and so the syndication part for me is just because I have cultivated a group of about 700 accredited investors just through my own show, and we're looking for deals together. We're a team, right? And so I'm just heading that up. So what I did, for example, in self-storage was, that was a typical, there was a split. There was a standard 30, 70, 70 for investors, 30 for GP, but after an 8% pref, right? In and out. So in that situation, what happens is I would like to work with owner-operators who generally who like the idea of really focusing on being owner-operators for the most part. Like the self-storage people I worked with, in their case, they really don't like raising money, right? That's why they work with family offices and they were working with other ways to raise capital. They like to focus on their craft. So what they're willing to do is give me part of their GP carve-out, their general partnership carve-out, in exchange for being the investor relations guy and bringing capital. And that's basically it.
No, that makes sense. I mean, just like us. I mean, we do both. I mean, we enjoy the operations side, but we're doing the capital raising as well. Whereas it would be nice. I mean, we have an investor relations. He's one of my partners. He does a great job at it, but we're really good at the operations side of mobile home parks. We're great at finding incredible opportunities, off-market opportunities, and great at adding value to those. But, it's one of those things where if you could pick and choose a la carte, which IMG would want to hand off, it probably would be, that would be one of them, the raising capital side.
Yeah, I hear you.
Yeah. Well, fantastic. So what is your long-term goals? I mean, as far as real estate's concerned, you're involved in a ton of other businesses, but real estate wise, you kind of mentioned what you're focused on today, but you own other properties outside of, some of the relationships that you've just recently created, like in the self-storage deal, but long-term goals for you in the real estate world. Well, what are they?
I think for me, I hear syndicators, talk about having a certain goal of, a certain number of doors or, having $1 billion under management or something like that. I don't really have any of those goals. I mean, I think the ultimate goal is just to continue, to find good opportunities, get myself into those opportunities and help my investors to do it. I don't know that I have a long-term goal of any kind. I already, through my businesses and through my real estate, my passive income already exceeds my living expenses. So I don't. So that's a goal I think a lot of people initially have, and I think it's a very good one to have. So I don't. So that one's done with. So everything else is icing on the cake. What I mean? Yeah,
fantastic. So. No, that's great. So you've been doing it. 2008 was when you first bought that. Let's call it the D lesson. The D apartment, the LoopNet lesson. 2008. So 10 years later, you've learned a lot, done a lot of deals, been involved in a lot of opportunities. If you go back into that year one, back when you were searching LoopNet and using that cap rate filter, knowing what you know today, what advice would you give yourself?
Well, as you know, Kevin, the biggest thing about investing, and I think is grossly underrated, is that it's a team sport, right?
Yeah.
And I don't care how analytical or how smart you are. And, I certainly thought I was, super smart. And I just went into it. I just, I didn't ask for help. I didn't look for mentors. I didn't look for, anything besides what I could read. And I think that understanding that investing is a team sport and that you really need to, if you're going into a dark cave, you really need to bring someone who's been there before with you. So.
Mm-hmm. No, that's great advice. In fact, I'm going to move on to what I like to call the Golden Nugget segment. And I hope you have a second Golden Nugget because that's a great Golden Nugget right there.
Yeah, right.
If you had one last final Golden Nugget of advice or wisdom that you'd like to leave with our listeners today, we're going to wrap things up here. A lot of our listeners they're seasoned, but we also have a lot of new investors that are just getting started that are back where you were in 2008 that are looking for that first opportunity, or maybe they've done their first one, looking for the second opportunity. But what advice would you give them that may inspire and motivate them as they progress in their real estate investing career?
Well, I think going back to the idea of tribe and tribal investing, I would say that the idea that your network equals your net worth is it is so unbelievably true. I mean, listen, I told you on real estate, I haven't lost money since 2009 when I bought that building, and it's not because I'm super smart. It's because I rely on people who are smarter than me to help me, right? Just because, and you talked about people, how you learn so much from making mistakes and that sort of thing. And I agree 100%. But here's the thing: they don't have to be your mistakes that you learn from, right? And so that's where the value of the network and the tribe comes in. And I will 100% tell you that it is, responsible for 99% of my wins.
Yeah, I like the old saying of power or proximity is power. Right. That's just those that you surround yourself with really do become your net worth. And you got to build a team. I mean, first and foremost, if you're out there searching for your first deal or looking to do your second, whatever it is, I mean, really spend as equal amounts of time networking and meeting others that are steps above you in that same niche, whatever it is you want to invest in. It doesn't matter if it's real estate or other types of businesses, but find those that have been there and done that, but not only that, but have been successful that have the track record. You don't want to be following the guys around that are actually out there losing money, that are buying bad deals or giving you bad advice. So, well, Buck, this has been absolutely fantastic. Pleasure having you on the show. And for those that want to learn more about Buck and his company, they can go visit him at wealthformula.com. Again, wealthformula.com. And Buck, that's all we have for today. Really appreciate you joining us, and I wish you the best with everything. And hopefully we'll talk again soon, my friend. You take care, okay?
Thanks, Kevin.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.